Hello and welcome to Portfolio Matters. New year, weekly episode 203. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. I can't quite believe it's 203.
I know.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So what have we got this week, Keith?
Well, it's a packed week. Happy New Year, everyone. It's been an astonishing start to the new year. Quickly, some housekeeping. So the next one will be in 2 weeks' time, but not on the Monday, at some stage during that week. So, first of all, the news. Well, it's been a busy start to the year as Donald Trump has upended geopolitics with his attack on Venezuela. We have a long section coming up. So, the US attacked Venezuela, captured President Maduro, but essentially left the socialist government in place. They've also seized various tankers of the Shadow Fleet that had been transporting Venezuelan oil, including a Russian flagged tanker in the Atlantic, which Britain helped with. It has placed an embargo on Venezuelan oil, and all Venezuelan oil will now be sold to US refineries. It's aiming to pressure the socialist government by controlling its oil exports. Trump has claimed that he will now run Venezuela. We will discuss that in due course. And Cuba, there are knock-on effects everywhere. So Cuba receives Venezuelan oil. Washington has warned Cuba it won't receive any Venezuelan oil unless it comes to a deal. There have been protests in Iran, causing the oil price to rise. Trump is considering strong military measures, he says. Trump only likes bombing things and short, sharp attacks. It's difficult to see what he can achieve with that in Iran, frankly. And overnight, federal prosecutors have opened an investigation into Jerome Powell over his testimony to Congress about the cost of renovations to the Federal Reserve building. That's putting more pressure on Jerome Powell. Basically, Trump wants him to cut rates. Not great. Okay, economic news. So we have a month's worth of economic data to get through. The main headlines are that the Bank of England cut rates in December and to 3.75%, a 25 basis point cut. And that was a split vote. 5 voted for a cut, 4 voted for no change. UK inflation came in really soft, and that was great news at 3.2%. Core also fell to 3.2%. Less good news was that Q3 GDP growth was only 0.1%. Year on year, 1.3%. UK is not growing strongly. The ECB kept rates unchanged at 2.15% when it met in December. The markets expect that the next interest rate move will be up. However, inflation softened to 2.0% in December, and the PMIs are weakening again. In the US, the Fed cut rates by 25 basis points to a range of 3.5 to 3.75%. There were 3 dissents, 2 for unchanged, and Trump appointee Stephen Millen voted for a 50 basis point cut. Q3 GDP growth came in at a red hot 4.3%. And the GDP now estimates show that the US economy appears to be strengthening, if anything. There is no sign that the US economy is slowing, although the labour market remains weak. And last week we had December non-farm payrolls, which were slightly weaker than expected, but unemployment dropped. The number of job openings, according to Jolt, are falling again. So these are Goldman Sachs's forecasts for global GDP growth. Pause, take a look. Bottom line is they're expecting global economy to be strong in 2026 and continue expanding in 2027. Traders see no chance of a Fed rate cut in January and are expecting two further rate cuts this year, at which point they expect US interest rates to bottom at around 3%. The markets seem totally unfussed by geopolitical uncertainty. You see that uncertainty has risen enormously, but VIX has collapsed. And as we go through the markets data, everything is strong. The Caracas stock market is up 150,000% in 5 years. Most of that's due to hyperinflation, but it's gone through the moon after the US attack. Okay, now on to Venezuela. So what happened? Well, on the 17th of December, the US instigated an oil embargo, blocking oil tankers from transporting Venezuelan oil. And then on Saturday, the 3rd of January, in the morning, US forces attacked Venezuela, seizing President Nicolas Maduro. In that attack, they also reportedly killed his Cuban bodyguards and destroyed the anti-aircraft missile batteries, including some Russian ones, which were very expensive. Maduro has since been extradited to the US, where he has appeared in court charged with drug trafficking offences. Trump claims that the US will run Venezuela for years, but there is no physical occupation of Venezuela. There are no troops on the ground. The Venezuelan socialist vice president, Delcy Rodriguez, has been sworn in as acting president. She has called for the return of Nicolas Maduro initially, but has since made more conciliatory messages to the US. Neither the opposition leader, Edmundo Gonzalez, or Nobel Peace Prize winner Maria Corina Machado were included in America's political plans for the country. The US has also seized Ghost Fleet tankers, and on the 9th of January, Trump cancelled the second wave of attacks on Venezuela, saying that the country is cooperating with the US. It hailed the release of political prisoners as part of that announcement, although only 12 out of 800 have been confirmed to have been released. Okay, so what's the plan? Well, the US does not currently intend to put troops on the ground and physically occupy the country. What it appears to be doing is intimidating the Venezuelan government into doing what the US wants via threats of more military attacks and an oil embargo in which all Venezuelan oil will be sold to the US and the proceeds used to buy American products for Venezuela, and for US oil firms to invest in Venezuela and boost its oil production. So all oil sales will be to US refineries, and the US will pay directly in US dollars the oil extraction taxes to the Venezuelan government. So Venezuela stands to benefit from receiving the market oil prices, where previously it was selling to China and getting less than the market price, and it will receive the its taxes in dollars. So this is Delcy Rodriguez. Now, reports suggest she was actually conspiring with the United States to replace Nicolas Maduro. So how that will go down with her socialist colleagues, I'm not sure. So why has the US acted? Well, although the Twitter sphere is full of stories about how the US has essentially aims just to seize Venezuelan oil. There are good geopolitical reasons for why it's attacked Venezuela. In particular, China has been investing in Venezuelan oil and minerals, and China buys the vast majority of Venezuelan sanctioned oil exports. Venezuela has also been producing Iranian drones with the support of Iranian technicians, and those drones are capable of reaching Florida. And Russia has been providing Venezuela with tanks, fighter jets, and missiles. Therefore, by attacking Venezuela, the US firmly establishes it within the US sphere of influence rather than in its enemy's sphere of influence. So this is one of the drones that Venezuela has now been producing with the help of Iranian technicians. That has a 2,000-kilometer range and can reach Florida. This is a Russian S-300VM air defense system, which reportedly costs about $2 billion and was capable of hitting hypersonic missiles, tracking 24 jets simultaneously, etc. Well, it didn't work very well because the US blew up both of them. So if you look at this map, the light green area is the Orinoco mining arc, which is around 12% of the country's territory and contains deposits of tantalum, tin, rare earth metals, etc. And China has been investing in it. So bringing Venezuela within the US sphere of influence also reduces China's hold over rare earth metals. Also, we talked previously on the podcast about how Venezuela had been threatening Guyana and threatening to seize two-thirds of Guyana's territory. Well, US oil companies have big interests offshore Guyana, and that threat has now been neutralized. There are also nice geopolitical knock-on effects for the US. So Cuba. Venezuela has been supporting Cuba with cheap oil since 1999. Cuba provides Venezuela with intelligence, healthcare personnel, i.e. doctors, cheap doctors, and security personnel. In return, Venezuela provides Cuba with 100,000 barrels a day of oil. Those will now be cut off, putting further pressure on the communist government in Cuba. China, well, attacking Venezuela removes a cheap source of oil and reduces China's influence in Latin America. And Iran, well, it has emboldened the Iranian opposition and reduced the threat from Iranian drones. So the tanker that the US seized in the Atlantic with British help actually never docked with Venezuela. It actually came from Iran. So what are the geopolitical implications? Well, first of all, the law-based system of international relations seems to be dead, if it ever really was there in the first place. The US acted unilaterally without any pretense of consultation or agreement with the international community, and it was a breach of international law, though probably not of domestic law. Bad for US allies who had previously relied on its security umbrella. The US is going its own way, basically, and bad for international security. Richard, any thoughts?
Yeah, well, a very nice summary of what's happening, Keith. I think very good, very interesting summary. You know, Trump, well, the US has acted in the US's interests, and unashamedly so, and in doing so, as you say, they've damaged a number of threats to the US, and yeah, from that point of view, it makes perfect sense. The problem is, as you say, that it is very undermining of international law. It's very undermining of the US's allies, in inverted commas, and makes them wonder if they are allies anymore.
Yeah.
I think it forces any sensible country to increase significantly its own defence and to strengthen its own alliances so that if it comes to be head to head with the US, it has some power to back it. It will make China and Russia and the Asian countries probably cleave more closely together as a bloc.
Yes, agreed.
Which will, whether that is ultimately good or bad for global security, I don't know. I think there are too many moving pieces. But I think what's going to happen is going to be, over the next few years, the consequences of this will be very significant, but hard to predict in detail.
Yeah. So investment implications, well, good for gold and physical safe haven assets, and very good for defense companies. So defense shares have risen very sharply. Bad for the oil price. Now, I know the oil price has risen in the past couple of days on the protests in Iran and the potential for disruption of oil flows from the Middle East. But Venezuela had been stockpiling oil because it couldn't export it. So its storage was full. All that oil is now going to be sold to the US refineries. And there's the potential for Venezuelan oil production to rise as the US oil companies start repairing the infrastructure. All that will add to an already oversupplied oil market in the coming year. It could also be bad for US safe haven assets like treasuries.
So I don't necessarily agree with you about the oil price, Keith. I mean, obviously there are going to be some short-term implications, but I think what it does is I think there's an active ongoing debate as to whether the world is really oversupplied and there really is a glut.
Sure.
And so not everybody is of the view that there's this huge glut. And secondly, it's going to make countries much more precious of their oil assets, which will probably mean that they are less happy for them to be distributed via the global oil trading system. I mean, you can see that China will want to annex its own supplies of oil, and it's not going to want to trade them. So I suspect the implications for oil are quite majorly disruptive over the next few years, and I don't know what the impact of that will be on the oil price, because it's another big area of uncertainty. I mean, China clearly is going to be looking for another source of heavy crude.
Yeah.
It's going when it gets it. It's not going to want the US to be able to swipe it.
Yeah. Well, I agree with you, Richard, is that it will certainly make countries more concerned about their domestic supplies and could lead to greater strategic stockpiling, which would be short-term, would be bullish for the oil price.
Yeah. Maybe Ed Miliband would reopen the UK oil and gas fields. I mean, you never know. Pigs might fly.
Yeah, pigs might fly, mate. So let's talk about oil. So the US has imposed an embargo on Venezuelan oil exports. PDVSA, the Venezuelan national oil company, had previously been reported to be shutting down oil wells because the US oil embargo had meant that it had filled up all domestic storage capacity. Now, allowing Venezuela to export oil once again, although only to the US, brings back 600,000 barrels a day onto the world market. And in addition, all the oil that had been in storage. So short term, there will be a surge in heavy crude coming back onto the world market. Chevron, Trafigura, and Vitol have been reportedly granted license to trade in Venezuelan oil. Now, the terms of the agreement reportedly are that the oil sold to the US, 20 to 30% of it will be paid directly to the Venezuelan government in the form of oil extraction taxes as required by Venezuelan law, and that would be paid in dollars. So that is the carrot to the Venezuelan government. That will be very good for a Venezuela extremely stressed. The remainder, net of fees, which the US oil companies will be taking, will go into an escrow account controlled by the US, and that will be used to buy American goods for Venezuela. All oil equipment purchases will be to US companies. The Economist was reporting that prior to the US attack, Venezuela had filled up its oil storage, including all its offshore storage, like oil tankers, and it had, what's that, 27 million barrels stockpiled. See, that's all going to come onto the market. That's why I'm thinking that the oil price should come under pressure if we if the protests in Iran lead nowhere, which sadly I expect they will lead nowhere.
Yeah.
So this is the oil price. It's had a bit of a bounce recently on protests in Iran. Now, what about future investment? So Donald Trump has stated that Big Oil would invest 100 billion in Venezuela to rebuild its decaying oil infrastructure. Rystad Energy have estimated that it would cost 115 billion to raise Venezuelan oil production to 2 million barrels a day, i.e. to double it by the early 2030s. So Rystad are saying essentially that it's going to cost a hell of a lot of money, and you're not going to get enormous increases in Venezuelan oil production. Venezuela used to produce over 3 million barrels a day. It's now less than 1 million, but you're going to need vast amounts of investment to repair everything to get back to anywhere close to that. Venezuela produces heavy oil, and its wells have high decline rates. You need to inject steam to get the heavy oil to move, and you then need to mix the heavy oil with naphtha or lighter oil to allow it to flow. This is not easy oil. Now, in order to get the oil majors to invest those vast amounts in Venezuela, they would need long-term security guarantees. Exxon have pushed back, saying they don't have those legal and commercial frameworks, and the socialist government remains in charge. They think it's uninvestable. But they are sending a technical team to Venezuela to have a look. Chevron are still in Venezuela, and they've committed to increase their production by 50% within 2 years. So let's have a look at oil in Venezuela. So first thing to note is it's heavy oil. On the left here, it's also sour, so full of sulfur. And difficult to refine, difficult to extract, and it has to be blended to flow through pipelines. But there is one hell of a lot of it. So it has reportedly the highest underdeveloped resources in the world, bigger than Saudi. Now, before socialism, it was producing over 3 million barrels a day. And then, they put the generals in charge and the cronies in charge, and it collapsed. Though it has been recovering recently. So previously, it was exporting most of its oil, 800,000 barrels a day, to China via the dark fleet because of US sanctions. So China stands to lose out. It was buying that oil at a big discount. It will now have to go to the world market and pay world prices. And this is the rig count in Venezuela. This is the effect of socialism, basically. Rusting away. And, socialists don't care about either people or the environment. So all that rusting infrastructure is causing frequent environmental destruction, oil leaks. So this is where the assets are. The Orinoco Belt, where you've got vast amounts of heavy oil, is actually in the jungle and is piped, needs to be piped to the coast. Now, US refineries were built to process crude, not light shale oil. So as the US has produced more light shale, it has had to import heavy oil to mix with the light shale oil to achieve the right input blend to go into the refineries. And you can see here how it's been increasingly importing heavy oil. And a lot of its refineries are on the Gulf Coast and originally were set up to help process Venezuelan heavy crude. So the resumption of oil imports from Venezuela would deliver heavy crude to the Gulf Coast refineries nearby and would be potentially very profitable because previously what the US refineries have been doing is importing heavy crude from Canada, which is a long way away. And yes, they're bringing it all the way across the US by rail and pipeline. So instead of bringing it all the way from Canada, you just bring it across the Caribbean Sea by. So other countries also have claims on Venezuelan oil. These are the claims from different groups on Venezuela. So China, Russia, Chevron is here, but also Vietnam. Now, Eni and Repsol are owed money for dilutants that they've been selling to Venezuela. So that's naphtha and light oil to mix with the heavy crude to get it to flow. And they have been trying to get the US to uh, confirm that they will pay those commitments, but have been getting nowhere, apparently. So whether the claims of Sinopec and Russian oil companies will be honoured is open to question. Venezuela also has enormous natural gas reserves, which could also be exploited if US oil companies came in. So what's the bottom line? Well, although Rystad Energy is saying that it would take vast amounts, like 115 billion, and 5 years to double Venezuelan oil production, Javier Blas, the Bloomberg energy consultant, thinks that Venezuela could actually boost production quite quickly by 300 to 500,000 barrels a day simply by repairing infrastructure. So he thinks there's some low-hanging fruit there, and that the market is overly pessimistic about the chance of the US boosting production. And frankly, I always think it's dangerous to underestimate US oil companies. They're amazingly technically proficient. So he expects Venezuelan oil production to beat short-term estimates, but to miss long-term estimates because the big infrastructure investments require a lot of money, and is the security there? Question mark.
So, what could possibly go wrong with the US plans is the question. And so, Venezuela is a violent country. The socialist government has used its armed militias to control the population and enforce social order. The guerrillas operate in the jungle, which obviously makes them elusive, difficult to find, difficult to attack. And the Marxist Colombian National Liberation Army is 4,000 to 6,000 people strong, well armed, well organized, been operating in the jungle on the Colombian border for the past 60 or so years. So they have very well entrenched infrastructure there. And the government has a bit of control over the collectivos, but little to none over the guerrillas. So central government is weak in any event, and any disruption to central government will further weaken them and strengthen the arm of the militias, collectivos, and the guerrillas. So it is an unstable place. There is, in addition, there's FARC. I think FARC was in the news years and years ago, wasn't it? Yeah. So in addition to ELN, there's Segunda Marquetalia guerrilla group, which is a splinter faction of the old Revolutionary Armed Forces of Colombia.
Yeah.
It's also operating on the border with Colombia. And the ELN has previously been operating in cooperation with the Venezuelan government. Question is, will that continue? And will they see it as cooperating with US imperialism? So clearly Trump does not want to put US soldiers into Venezuela. And clearly if he did, it would be Afghanistan, Iraq, all over again, would be doomed to failure. So the US government is saying that they control Venezuela. They need to be really, really careful about how they manage the Venezuelan government. Homicide Monitor says that Venezuela has the 9th highest homicide rate in the world. 5 of the top 10 being popular tourist destinations. Why are they popular? One would say.
Well, absolutely. So, when you say that it's incredibly violent, well, it doesn't seem to put people off going to, let's say, Trinidad, where second highest murder rate in the world.
So I think what the US government has to do is it obviously has destabilized the government to an extent by kidnapping Maduro, but it needs to ensure that the rump of the government is able to maintain the confidence of the army. So the Interior Minister, Diosdado Cabello, who's a committed socialist, a former ally of Hugo Chavez, controls police, intelligence, and the collectivo militias. He is a potential threat to the government of Delcy Rodriguez, hostile to the US, which has an arrest warrant out on him, and is likely to pose any form of political change, and has the potential, the militias behind him, to cause chaos. So what the US government will want is for Delcy Rodriguez to keep her interior minister on side.
Yes.
And that's really important to the US. Otherwise it falls apart.
So it seems that if there's any attempt to change the government from socialism to, a liberal democracy, you'll unleash chaos. So actually the stable equilibrium will be a socialist government that cooperates with the US in order to receive oil money, and the Venezuelan people continue to be repressed, basically.
Yes, I think so. And the reason that the woman whose name I forget, who won the election, hasn't been called back to be president, is because to do so would immediately tip Venezuela into complete chaos.
Yeah, I think that's true. So this is real realpolitik.
Absolutely, yeah. So the collectivos are these armed militias used by the social government to maintain social order. They stop citizens in the street to check their mobile phones for anti-government sentiment, and they are able to deal out arbitrary punishment. So it's the Wild West, basically.
Yeah. So you notice that there were no celebrations on the streets of Caracas because the collectivos will come and get you.
Yeah. So the question, can the US deliver security? Well, it depends how you define security, I suppose, doesn't it? Big oil is only going to invest if the Venezuelan government can guarantee physical security of its assets and legal security of its contracts, which it can't.
Yeah.
So the only way they would then invest in Venezuela would be if the US government. Well, I mean, there are two governments. The Venezuelan government clearly can't guarantee, and Trump has indicated that he doesn't wish to guarantee. So the consequence of that really is that while Chevron is already incumbent working there, they can increase their production. No one new particularly wants to go in there. A few wildcat companies may go in and try and set up
Mm,
operations. But getting a really significant increase in production of oil there requires a change of regime.
yeah, yeah. Alternative, you could see the Venezuelans, if they could invest, rather than US oil companies coming in, if the Venezuelan government were to use some of the US dollars to come in to repair assets themselves, you could see
You could
some
see
boost.
you could see a gradual
Yeah.
improvement in circumstances, couldn't you? And maybe a gradual edging out of the military control or the militia control,
Mm,
possibly. But given that effectively the current government has overseen the decapitation of the oil industry, it's hard to see how they could then oversee its resurrection.
yeah.
And, you know, this is not about securing vast amounts of oil for the US. It's about, I guess, securing what there is left of it, and denying Russia
I
and
agree.
China.
Yeah. I think there's geopolitics, and Trump also wants to get the oil price, the gap price at the pump down is one of
He's
his stated aims.
desperate to get the oil price down, isn't he?
Yeah. Um, so if you're interested in companies that potential US companies will potentially benefit from investment in Venezuela, then Chevron is there. It is best placed to benefit from the opening up of Venezuela for US investment, and it has stated that it will be increasing its Venezuelan production. ExxonMobil, they once had a presence in Venezuela, but their assets have been confiscated twice. So they're wary of going back. But anyway, their share price has risen on the potential that they will. ConocoPhillips also once had a presence in Venezuela and is familiar with the assets there. New Stratus Energy previously had a joint venture in Venezuela, which it repudiated on the election of Donald Trump because that it would seem to have that a joint venture would seem to then have breached the sanctions. However, they retained an option to buy it back for $1, so they potentially could do well. And then it's the big oil service companies whose share prices have surged in recent days on the back of, they certainly will be getting more equipment sales into Venezuela. Whether the big oil companies will feel confident enough to contract them to go into Venezuela or not, I think is a very open question. So that's Schlumberger, Halliburton, Weatherford, share prices all done well. Baker Hughes,
Interesting, though, Keith. If you just go back over those graphs, they've been doing well for basically the last 12 months.
they have, which is quite odd given, this is the funny thing about, the oil price has been going nowhere.
Mm.
Oil companies have been joining in the general rise in the stock market.
Yeah, there's also been a deficit of exploration, hasn't there? And I wonder whether oil companies are actually starting to increase their exploration now, which is
Yes.
being reflected in the order books of the oil companies. I don't know
Yeah,
enough about them.
yeah, no, that's a very good point, Richard. If because we on this podcast have been looking through the low oil price of this year and next year, looking to the decline of shale, and then medium term, the oil price going up a lot. And I wonder whether international oil companies are doing exactly the same thing.
Yeah, I wouldn't be surprised. And that would then account for the rise over the last 12 months or so.
Yeah. So, what's Trump going to do next? Well, this is a chart of all the countries in the world that Trump is currently threatening. And the big one, of course, is Greenland. So in recent days, Trump has reiterated his demands that Greenland should be part of the US, again threatening to use military force if necessary. And You'll all be aware of the speech by Stephen Miller, in which he stated that Greenland had to be part of the US, and he's a special advisor to Donald Trump. Um, Now, the trouble for Trump is that seizing Greenland would require the approval of the US Senate, and he can do a tax on his own authority based on just describing them as threats to national security. But he can't seize Greenland on the basis that it's a threat to national security. And I was listening yesterday to a speech by a Republican congressman describing how Danish troops have been died in Afghanistan on supporting US troops, and Denmark was a key ally of the US, and seizing Greenland were just insane, to quote his words. So whether he can seize Greenland is open to question, but he's certainly going to put a lot of pressure on Denmark to allow access to US access to Greenland. Richard, your thoughts?
I'm a bit bereft of words, really, because there, if the US wants to put more security bases around the northern coast of Greenland to detect Russian, Chinese submarine activity and so forth, I'm sure it could negotiate with Greenland, stroke Denmark, to do so. I don't see there would be any issue with that whatsoever. As far as the noticeable thing about the map that we have out there, Keith, is it's Greenland ice sheet, isn't it?
Yes.
And basically, the Greenland ice sheet means that most of the minerals in Greenland are inaccessible.
Yes.
Or if you want to access them, it's incredibly difficult and incredibly expensive. Greenland has got mineral reserves. Obviously, it doesn't. I don't think it has anything particularly extraordinary. And I do understand that its rare earth deposits are quite difficult. Have a difficult chemical composition to refine, so they're not ideal. There is a rare earth mine operating there. It just seems like this is. It doesn't make sense. But of course, that is not a rational argument to use against Trump.
Yeah.
So that's why I'm a bit. And if he does seize Greenland in inverted commas, then that is the end of NATO.
Yes.
And the consequence of that, obviously, is massive for. It's not the end of NATO, but it means that NATO has to be able to sustain itself without the US, which you could argue it should have been able to do, and has been very derelict. And the countries of NATO, apart from the US and maybe a couple of others, have been very derelict in their duty to maintain their own national defence. Very stupid. But that puts Europe in a very weak and vulnerable position.
Yeah.
And means that Russia basically has nothing to fear in invading Ukraine.
That's true. Yeah.
So
it would be very bad for Ukraine.
Very bad for Ukraine.
It would be very good for European defense companies.
Yeah. And I sort of wonder, I do wonder vaguely. Has Trump basically despaired of Putin? And is he actually basically saying, I don't want to be involved in Ukraine. I don't really care anymore. This is a money pit. I'm not prepared to sink any more money into. I can punish Russia by sanctions and hijacking their ships on the high seas. And I don't care about NATO. So if I want Greenland, I'll have it. And NATO can take a running jump. Is that his calculation?
Well, I personally fear that Trump is emboldened. He clearly likes these attacks. These are using military force. Basically, the US is very good at attacks. But also he fears the midterms because his approval rating is very low. He's likely to lose the midterms, and therefore his ability to prosecute his agenda in the second half of his term, it will decline. And I really worry that he's now going to try and do whatever he likes before November.
In the next 8 months is going to be total turmoil.
Yeah. And frankly, Stephen Miller wants Greenland. And, Trump, I think, will try and deliver by hook or by crook. So, whether he'll do it, I would doubt that he will just seize it.
I
But
mean, you have to sort of think if the rest of NATO, the non-US bit of NATO, does its job, then you
mm,
get a shooting war off the coast of Greenland between the US and the rump of NATO. I
that's
mean,
not
that's
going to
it,
happen.
isn't it? That's what
Yeah,
should happen if
that's
Trump
what should
does.
happen. Yeah, yeah,
And in some senses, maybe it should happen because otherwise, there's no limit to what Trump does.
yeah. Nobody's going to want to die for that, though. Just, put some egg on Donald Trump's face. The reality is, NATO has always acted at the behest of the US, essentially, since the
Yeah,
Second World War.
yeah.
Um, and, is it capable of doing much on its own without the US leadership? Question mark. You know,
No, no, it can't.
yeah. You can't attack by consensus, which is one of the great things about a democracy.
I mean,
Democracies don't like wars.
that's the irony, isn't it? If you had a shooting war between the US and the rump of NATO off the coast of Greenland,
Mm,
the US would win. I mean, absolutely, hands down.
mm, yes. Um, so anyway, this is a table of all the countries that the US is currently threatening, frankly. And since I did this, which I did this on Saturday, on Sunday it bombed Syria. So, all this is actually happening. And Trump has been talking about military action in Iran in support of the process. Now, on Greenland, I think it's highly likely he's going to get his way somehow. Likely to involve a political deal rather than military force in my books, but he's putting a lot of pressure on Greenland and, on Denmark. So, and Denmark will want to come to a deal of some kind.
I mean, there is a legal principle, isn't there, that contracts signed under duress are not contracts, are not valid. So Denmark
Yeah.
could come to a deal and then say once Trump's out of the way, say, well, we're having it back now. It's off.
Yeah, that's not going to work. They did sell the Virgin Islands to US but last century,
Did
in
they?
the
Denmark?
1917. Yeah,
I
yeah,
didn't know that.
for $25 million.
That was a bargain, wasn't it?
Yeah. So, there's countries have bought and sold territories, since time
Yeah.
began.
Oh, of course, the US bought Alaska from Russia for $1, didn't they?
Absolutely. They bought the Louisiana settlement from France. Best deal in history.
Yeah.
So, also, Greenland could declare independence from Denmark and then, do whatever it likes.
Yeah. Or do whatever it likes as long as Trump agrees.
Yeah, this is it. The Don Road doctrine. I quite like that. So I fear that he's in a hurry to get his agenda completed before November.
Yeah.
And notice that the Panama Canal is back on the agenda as well. And the betting odds on Trump taking the Panama Canal have surged. Be afraid. So, in addition, not just geopolitics, this week he's been messing around with domestic economic policy. So, he announced that he has directed, so this is actually going to happen, the federal mortgage guarantee agencies, that's Fannie Mae and Freddie Mac, to buy 200 billion of mortgage bonds to drive down home mortgage rates, and that's
Yeah.
good for banks. Good for banks because they hold loads of MBS and the price just went up. Good for homeowners and good for the economy. But this is command economy stuff. When the market isn't doing what you want, you interfere in the market in a socialist manner to move prices rather than allowing the free market to set rates and prices as it should.
So I sort of agree with you mostly, Keith, but I do think that the ban on big investors buying single family homes is right. And I don't think companies like BlackRock should have massive portfolios of single family homes. I think it's I think it's socially wrong. That's not what they're bought for. That's not what they're
Mm.
for. And it's basically it's making the wealth inequality even worse. It's happening in the UK as well. And I don't think it should be allowed to happen.
If you can appreciate,
I'm a socialist conservative.
well, we all people regularly call me a communist so, on this after my comments on this podcast. But so yesterday I ran with an architect, and he was saying that it's currently uneconomic to build new houses in London. So he was saying that since Brexit, house prices in London are flat to down, and costs were up by a third. And the only people who are building to buy to rent. So all those huge blocks of flats going
Yeah.
up, they're for rent. Now, to my mind, that's a good thing. You know, if you can't buy to sell, at least the big corporations are, doing buy to rent and increasing the
Mm.
rental capacity, the number of houses for rent in the capital. So,
Yeah. Yeah. Two sides of the argument.
yeah. But he's also called for a 1 year cap of 10% on credit card interest rates starting on the 20th of January. Now, whether he can achieve that, he just says these things, but whether
He
he can
can't.
achieve that,
I
yeah,
don't think he can achieve that. I don't think he can achieve it, but this is all part of his as you say, of his targeting the midterms, isn't it, and increasing his
yeah,
domestic popularity.
yeah. Because if you did that, essentially credit card companies would just stop offering credit to people they considered bad credit risk. And it would be good for loan sharks and good for um, Klarna and these buy now, pay later companies.
Yeah.
Yeah. Very bad for credit card companies. He's
Mm.
also called for a 50% increase in the US defense budget to 1.5 trillion and for US defense companies to cease paying dividends or doing share buybacks until they've met production and quality targets. Now, if he managed to do that, very bad for the fiscal deficit, good for defense companies and the economy. So, the US is already running a budget deficit of 6.1%. There's no pressure from Trump to reduce that. If anything, he just wants to, increase spending.
The trouble is, Keith, with all of this is he chucks stuff out
Yeah,
willy nilly, some of which is bonkers, some of which isn't, some of
yeah,
which is borderline, and so you never know. And then some of it you never hear of again, and some of it he he
yeah.
he prosecutes. There's so much that comes out that it's 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 virtually impossible to process what the consequences are going to be because you don't know how much of he's making up and he's going to just disappear.
So Fannie Mae and Freddie Mac's purchases of MBSs appear to be working. So bond prices have risen and yields have fallen. And this is really interesting, actually. So the black line is Fed funds rate, which has been falling. But of course, because the US is running an enormous fiscal deficit and the markets are worried about that its sustainability, 30-year bond yields have not fallen very much, which means
Yeah.
mortgage rates have not fallen very much. And so Trump has now intervened. The extent to which he can manipulate mortgage rates down is open to question when the 30-year rate stays high. As we've said many times, a big fiscal deficit is good for creditors in that it keeps rates high and bad for debtors, so
Yeah.
the poor. Bottom line, Trump is emboldened and he's interfering in markets of all kinds. Expect more chaos and more of these sort of one-off interventions to try and manipulate prices in the direction he wants. in particular, so you've seen today that he's got federal prosecutors to open investigation into Jerome Powell. He's going to try and take over the Fed and manipulate US interest rates down. So expect more chaos. Gold and safe haven hard assets are potential beneficiaries. Bottom line, be nimble. Things are going to change and we need to react. And that's my resolution for the year, to be nimble. So market news, quick summary. Well, it's been amazing, amazingly strong start to the year. First 2 weeks, particularly hard commodities. Equities have continued rising, but industrial commodities is amazing. Lithium up 28%, copper up 7%. We'll go through the numbers in due course. Precious metals red hot. Silver up 18%, platinum up 16%. We'll discuss that when we get to it. On to equities, Richard.
Thank you, Keith. So the right-hand column, which is headed year to date, is actually the 2025 full year results for these for all the various indices. So most of the markets had pretty good return of around about 20%. The Russell 2000 was less at 11%, but generally speaking, a pretty good year for the equity indices. Not so much for Bitcoin, which is down 4.5%, without having had a big rise in the middle. The dollar index is down nearly 10%, with the pound up 7% and the euro up 13% for the year. And the VIX overall was down nearly 14%, which is what you'd expect from the performance of the equities.
Yeah. But given the, global chaos, geopolitical chaos, the markets are remarkably complacent.
They seem to be ignoring it, don't they? Yeah. So this is this now is the year to date, and obviously the weekly change in year to date change currently the same. So basically the world stock markets have all continued their upward trend. In fact, with the Russell 2000 doing particularly well at 5.7%.
Yeah.
And the stocks Europe doing pretty well at nearly 3%. Hang Seng up 3.6%. Topics 3.1%. Bitcoin reviving a bit, up nearly 4%. And the pound and the euro slightly down against the dollar. The dollar index slightly up 0.7%. And the VIX continuing to drop.
Yeah. So a couple of things. The performance of the Russell 2000 is really interesting because that is the great mass of US companies. And what that is saying is the market thinks that the US economy is strengthening.
Yes.
The other thing is the performance of the Euro stocks and the all share have been, despite frankly weak UK and European economies, and shows once again that the stock market is not the economy. And that's something that, a lesson I need to keep on relearning, basically, one I got totally wrong.
Yeah. No, I would agree with that, Keith. So there's no particular rational reason why the FTSE, for example, the UK market has reached all-time highs, although it has remained very moribund for the last 20 years.
Yeah.
It's a tricky one. Stock picking is all important.
Yeah, when the US goes up, everything goes up, basically.
Yeah. So that's the FTSE All-World Equity Index over the last 12 months-ish.
Yeah, looks pretty good.
Yeah. The FTSE All-Share.
Yeah.
The Stocks 600. S&P 500. The NASDAQ.
Yeah, it does seem to be flattening off a bit in that case.
Yeah, it's all had a quiet 2 months, hasn't it, Keith? Which is considering what it did from April onwards.
Amazing.
Yeah. The Russell 2000 and Hang Seng. The topics. That's Bitcoin, which basically is sort of roughly where it was at the beginning of 2025.
Yeah, but noticeably a laggard compared to everything else.
Yeah. the pound against the dollar, essentially sort of unchanged since the summer.
Yeah.
And the euro, likewise, against the dollar. The dollar index, the reverse almost of that, so unchanged since the summer.
It's noticeable that the attack on Venezuela did cause a bit of safe haven buying, so it caused the dollar to strengthen.
Yeah.
I would have thought it would be the other way round now, frankly.
The response. Everything's in a big state of flux, isn't it? So the Japanese carry trade is coming away.
Yes.
There's huge changes in the investment world at the moment. This is the VIX, which is pretty much as
Dead
low
as
as
a
it's
dodo. Yeah.
ever been. Yeah. European defence stocks 13% up so far this year, and up sort of like 50, more than 50% since the beginning of 2025.
Yeah, amazing.
And analysts, dear old analysts, all remaining bullish. Probably going to be right. That's the death knell. Reasons to be bullish. This is part one, is it?
Yeah.
Progressively more S&P for earnings forecast this year, next year, have been on a tear. So
yeah, market's expecting earnings to just keep on rising.
Yeah, of course, if the GDP is up by 4% ish on annual return, that's not unexpected.
Yep.
And there is a lot of long equity positions. Equity allocations are high, nearly 70%.
Now, this is extreme. Now, we've talked many times about how there's an inverse relationship between equity allocation and future returns.
Mm-hmm.
But you're now seeing the equity allocation is higher than it was in .com, and highest as ever. And the reason that the stock market is doing so well is this allocation is rising.
I wonder if part of this is the reciprocal of equity allocation, really, is allocation to bonds.
Yes.
I just wonder if people don't really want to be in government bonds anymore because, generally speaking, because there's so much, governments are so indebted, they see them as no longer being particularly safe.
Yeah, well, but markets are worried about inflation and the sustainability of deficits.
Yeah. So if you can't go into bonds and you're a big investor, where do you go?
Yeah.
Well, I'd say gold, but
yeah.
US consumer confidence surveys percentage expecting stock prices to be higher in the next 12 months. Pretty bullish.
Yeah.
And Buffett's Berkshire Hathaway sells stocks for the fourth consecutive quarter.
Now, actually,
building up its cash pile.
He is, yeah. So he thinks things are overvalued. I saw an amazing stat though that, and this is like hope for all of us. So when Buffett was 65, he was worth 3 billion. Okay.
Right. Yeah.
Now at the age of 95, he's worth 128 billion. So, power of compounding, but
40-fold.
Yeah. So there's hope for all of us as we get older. Time is, you've got like me, messed it up. There's plenty of time to get it right.
We just need to adopt the Buffett investing style, Keith.
Yeah. What, sell now? Go to cash.
So if the AI bubble follows .com, this is what it would look like. This is highly speculative.
Yeah. Yeah, these charts is like the last refuge of the charlatan, basically.
Yeah.
But anyway, it could happen.
It could. You heard it here first. It could happen. And still ongoing foreign purchases of US equities because US companies are the ones that are doing well.
Well, it's the big tech monopolies, isn't it?
Yeah.
Video being the latest one.
Yeah.
60% margins.
Yeah. Very, very profitable. So when the dot-com bubble burst, the whole market went down with, except the energy, consumer staples, and utilities, which didn't go down; they went up.
Yeah, you see this. So I was interested in this because I was thinking, okay, at some stage, I really think the tech bubble, the AI bubble bursts.
Mm.
But does that mean, energy stocks, etc., will go down with it? No, it doesn't. They could be fine. So when we talk about, safe havens from,
Mm.
overvalued market,
Yeah,
energy, which I'm aiming to, buy into over the course of the next 2 years,
yeah,
should be okay.
yeah, possibly so. Difficult. I mean, I'm not sure the AI bubble will burst. It might just slowly deflate. And financial conditions are getting looser.
So just going back on the bubble, uh,
Yeah,
whether there is one or not, previously we've shown that chart of the share price of Zoom,
yeah,
where the revenues go from 5 million to 200 million or whatever,
yeah,
and the share price goes in exactly the opposite direction. I
yeah,
mean, frankly, that's what I expect of Nvidia to do. I think it's just discounted as growth slows,
yeah,
so it'll go X growth.
yeah. I think you're right, Keith. But my view is it may not it may not be a bubble that bursts. It may just slowly
Yeah,
decline,
sure.
and it won't be such a dramatic event as say a dot-com burst, the dot-com bubble. I don't know, but my sense is maybe that might be the way.
Mhm.
So we're moving into a period of high seasonal volatility. So watch this space.
Yeah. So right now we're here at low volatility,
Yeah,
but
yeah. All the makings are in place, aren't they?
yeah. Well, exactly. Everything's been going through the moon.
Yeah.
Okay, so let's have a quick look at the Kalecki-Levy formula. So reminder, corporate profits equals investment minus household saving, minus foreign saving, minus government saving, plus dividends. So for corporate profits to rise, you need households to spend more, i.e., cut their saving, foreigners to spend more, i.e., for the trade deficit to increase, and the government saving to decrease, i.e., the fiscal deficit to also increase. So, why are corporate profits so high currently? Well, it's because the US government is running an enormous fiscal deficit, and the US is running a current account deficit. But the households have not been um, dissaving. So obviously, the big thing really is the US deficit. So what's happened in my books and why the US stock market is doing so well is that the US has gone from pre-pandemic running a small deficit of 2% or so to running an enormous fiscal deficit, and that seems set to do so ad infinitum. And so the market is now discounting higher profits based on more fiscal largesse forever. So actually, household savings have been rising over the past couple of years, and that is a headwind for US corporate profits via the Kalecki-Levy formula. But this is it. You know, prior to the pandemic, you were having deficits which were much lower than they are now. And the market is projecting higher deficits of 6% plus ad infinitum. Historically, profit margins have been mean reverting, and that means the margin adjusted CAPE is a better valuation measure than pure CAPE. So, and it's showing that basically the market is extremely overvalued based on the sustainability of profit margins, which is based on the sustainability of the US fiscal deficit. So actually, I thought this was a really interesting chart. This is on the x-axis here, you have the real level of the S&P 500, and on the y-axis, you have corporate profits as a percentage of GDP. And there's a very clear relationship, frankly. Higher corporate profits are as a percentage of GDP, higher the S&P is. So if, and this is a big if the US were to rein in the deficit, that would be very bad for corporate profits and for the level of the stock market. Now, the market is concerned about the absolute level of US deficits. It's already spending about $1 trillion a year in interest, and that is due to double in the next 10 years if deficits continue at this pace. It is totally unsustainable. At some stage, there's going to be a change. Currently, 2025 interest is around 970 billion. That's 3.2% of GDP. That's a lot. And it's forecast to double in the next 10 years. 10 years. That's clearly a totally unsustainable path. So there will be some GDP growth over that period, but you're talking about it's going rising to, it will certainly rise as a percentage of GDP. That can't continue indefinitely. So bottom line is, stock market is booming because of the US fiscal deficit, which is unsustainable. Something has to give. I'm not sure what it's going to be. Either the US reins in the fiscal deficit, or you going to end up in some inflationary bust or financial crisis.
Yeah.
Watch this space. And on to commodities. Quick summary. Well, energy generally strong. Oil rising on the back of tensions in the Middle East, except for US natural gas, which has fallen on the back of mild weather. Industrial metals red hot. Lithium up 29%, copper up 7%, precious metals red hot. Silver up another 18%, platinum up 16%. That is year-to-date numbers, by the way. And onto energy commodities. So this is figures for last year, and oil had a bad year. You wouldn't know that from oil equities, but oil was down 18% on the year. Natural gas down 44% on the year. Great for European consumers. US natural gas, though, was kind of flattish. Coal down 14%. Uranium bull market back on. This is the year to date. So Brent having a good couple of weeks, up 4%. US natural gas down 13% on milder weather. Uranium ticking higher. So this is Brent. Say the trend is still firmly down. WTI the same. So these are numbers specific to the oil market for last year. So over the course of 2025, the US saw a total crude bill of 75 million barrels. So quite a large build, a market oversupplied. Oil production rose by 250,000 barrels a day, which I don't think anyone was expecting because the rig count fell by 70. So year to date, the build has continued. We don't yet have global oil inventory numbers for December. Oil production is pretty stable, close to its highs at 13.8 million barrels, and the big Baker Hughes rig count continues to fall. So US continuing to produce more oil with fewer rigs. This is US oil production. Ain't coming down. Now, the latest Goering and Rosenzweig piece points out that Permian shale oil growth has now gone negative year on year, although natural gas liquids production continues to rise. Other shale plays have actually peaked years ago. So this is the thesis that basically shale oil production is peaking, will peak within the next couple of years, and then the oil price should start to rise. Now, Iran actually, I know the oil price is rising because of protests in Iran, but look at that. Despite US oil sanctions, Iranian oil production had a good 2025, up 500,000 barrels a day, and highest it's been since the 1970s. Much of the current excess supply is due to new projects in Latin America, which were sanctioned years ago, particularly Guyana and Brazil. In real terms, the oil price is dirt cheap. It has gone nowhere in 25 years. And so this is divided by inflation. Okay? In real terms, gone nowhere in 25 years, and it tends to be mean reverting. And this is the thesis. When oil prices are low, nobody invests, which leads to a lack of new supply in the future. And also, you'll see later we have a chart showing there is a good correlation between oil prices and inflation expectations. So the reason that inflation expectations have come down over the past year is that the oil price has fallen 18%. Now, if and when the oil price starts to rise, inflation expectations will also start to rise, and bond yields potentially will start to rise with it. So something to be aware of. Now, while we talk about oil, Rich and I have talked previously about how I am very skeptical of oil analysts because they have a huge bullish bias. And I came across this, which is actually from 2018. And back then, so 7 years ago, there was a lot of talk about peak oil. And analysts were using Hubbert linearization, the size of the oil assets basically, to predict that US shale would soon start to fall. So they're predicting that US shale from the Bakken would collapse starting in 2018. It didn't. Although it is down actually, but it's been stable since the pandemic. They are forecasting that the Permian would also collapse. It would be down 30% by 2025. Well, it didn't. It rose by, what's that, 50%? And they're forecasting that US shale production would fall by 75% by 2025. It didn't. It kept on rising. Now, where we are now, and this is a really important chart, this is numbers from the EIA. And they are forecasting that US shale will soon peak and then start to decline depending on the oil price. Obviously, the higher the oil price, the more rigs go into operation and you can boost production. But over the past 10 years, 15 years, US shale has been the big marginal producer. That is coming to an end, and it will come to an end under all circumstances by 2030. So within the next 4 years. And that is long-term huge bullish for the oil price. So bottom line, frankly, I'm just very wary of peak oil and claims that there's going to be a shortage because the oil industry is right at the cutting edge of technology and they always find a way of finding new resources in obscure and difficult to reach places. I mean, the fact that the oil price is flat in real terms over the past 25 years when the amount of oil consumed in the world has risen by a third is astonishing. Now, continuing to talk about oil, a story I came across thanks to my US fund manager friend is further problems in the Permian. Now, this is really interesting. So, for every barrel of oil extracted from the Permian, you also extract about 5 to 6 barrels of nasty, salty water. Now, for years, they pumped that deep underground under high pressure, but that caused little earthquakes. And so the Texas Railroad Commission then stopped that practice and forced shale drillers to dispose the water in more shallow reservoirs. But this wastewater was injected at about zero point 0.7 pounds per square foot, high pressure, and that's more than sufficient to allow it to escape back up to the surface. So what's happening is this wastewater is migrating into old wells and then bursting out back to the surface. So oil companies have to go around then finding these, sealing them off, and it's sort of whack-a-mole. And you can see this process in action from this just this small area of Texas called Tubbs Corner. So this is all from the Wall Street Journal. So back in 2021, wastewater from oil production was injected into the ground, and this flowed south through the path of least resistance, raising the pressure, forcing the ground upwards. But then in 2022, that wastewater broke into an old well and there was a blowout. It sprayed salty water over the surrounding area until it was capped. At that point, the ground subsided as the high pressure had been reduced. But then pressure started building again because you're still injecting wastewater, and the ground started bulging up until again it found a different well and blew out, and the same thing happened again. Now pressure's building. So you have this whack-a-mole problem with wastewater, and fracking is just causing increasing environmental damage as you've got thousands of old wells. And there is a solution to this, which is to only inject the wastewater in areas which are considered where it's considered safe to do so. But that would require regulation and transport and would add costs. So essentially, there are big environmental problems with fracking, which may cause problems as the number of wells keeps on multiplying.
Yeah.
So this is EU natural gas futures going nowhere. That's great news for EU consumers. Same for the UK. US natural gas futures fallen heavily on the fine weather or milder temperatures there. Coal going nowhere. Uranium. The bull market is back on. Marvelous for Richard. And on to industrial metals, Richard.
Thanks, Keith. So a good year last year for all of the industrial metals, with the exception really of iron ore and zinc, where it was marginal. Particularly good for cobalt, which is up 117%.
Yeah.
Copper, which is up 41%. Lithium was up 58%, and neodymium was up 51%. Tin up 40%. So some very big increases.
Big moves.
Industrial metals last year, yeah. And the first few days of this year have seen similarly astonishingly large moves in such a short period of time. So aluminium, cobalt, and copper all up 5 to 6%. Iron ore actually pretty much unchanged. Lithium, as Keith mentioned earlier, up 28%. Neodymium 5, nickel nearly 8, tin nearly 8, and zinc 2. And it's like everybody has suddenly decided that these industrial metals are going to be in short supply in some way, and therefore people need to secure positions in them. Who knows? But
yeah, it's just it's totally unsustainable. They can't keep on rising at this pace.
No, but whether it's
But the thing is, Richard, I was thinking about supply and demand in these markets and what what can bring the copper price down? Now, the thing is, in the short term, I say even in the medium term, the supply of copper is essentially fixed.
Yeah.
And so you have to have, in order to balance the market, you have to have demand destruction. Demand has to adjust. Now, I think what is causing, the copper price to rise is financial buyers at this point, and I think it's the same for most other markets. But if supply and demand are largely fixed in the short term, which I think they are, in say the copper market, then the price can move a lot, really. Between and the price is set by anchoring to what the previous price was. So if you had to move the price up 30%, how much demand destruction are you going to get? I suspect actually not that much. Certainly at the high end, like it's so use in semiconductors, that's not going to affect demand at all. At the lower end, where for piping in central heating, perhaps you can substitute for plastic or something. But
Yeah. No, I agree. There's clearly a certain amount of preemptive buying in the copper market, isn't there? There's a lot of statistics that suggest there's going to be a shortage of copper beginning in about 3 years' time, I think, roughly speaking. And there's a lot of
yeah,
preemptive, there must be a lot of preemptive futures buying there. I don't know why the others particularly are moving. I mean, they've all been at the bottom end of their price ranges for a long time. If you look at any sort of combined commodity chart, they're all at the very bottom end of their trading ranges for multiple decades. And I think people are also speculating that this downward trend in commodity prices is going to reverse.
yeah.
Maybe they're anticipating the sort of inflationary burst that you were talking about with how does the US get, not just the US, but how does the US get out of its fiscal mess? Answer by inflating away the debt. Maybe people are anticipating that, but clearly there is a big move into these commodities.
Well, the trouble is that narrative, Richard, is that inflation expectations are actually really low.
Well, yeah, but I guess inflation expectations they're not the inflation expectations of fund managers and hedge funds, are they?
Yes, that's true.
So, and
Yeah,
who are better informed and more thoughtful about these things. So, I mean, and if either the debt has to be inflated away, and it has been inflated away. I mean, if you look at what's happened to the US dollar in the
yes, of
last
course.
50
Yeah,
years, it's lost 98% of its value.
yeah.
It has been inflated away. It's going to continue to be inflated away, but at an accelerating rate, I suspect. So, the consequence of that is people want to be in hard assets.
Yeah.
Well,
I suppose the thing is that inflation expectations reflect expectation that the status quo in the world will remain the same. And actually, these may be discounting the possibility that that the status quo is totally unsustainable, and
yeah,
there will be a single just a phase change at some stage. And
yeah, I think that's right. And I think the status quo is completely unsustainable. But I thought that for 10 years, and
yes,
it has sustained for 10 years, and it may sustain for another 10 years. At some
yeah,
point, it will cease to. And as time goes by, that likelihood increases. Likelihood of it happening in a particular year increases.
yeah,
So yeah, so there we have the chart of aluminium,
yeah,
cobalt.
still rising.
Yeah,
Although there's still loads of it. It's just the government of the DRC is messing around with quotas, etc.
copper.
Yeah, yeah, it just
Race,
keeps on rising. All
race.
these commodities trying to call the top is just impossible.
Yeah. And this is the forecast for Bloomberg copper will be a 19 million ton per annum deficit by 2050. Obviously, 2050 is 25 years away, but basically either demand has to drop or supply has to increase, both of which
Yeah.
The moves have to be substantial.
Yeah. So obviously, economics 101, this can't happen. You
Yeah.
can't have a deficit of
So
the
there's a different solution.
exactly. Now, as you also, so I'm working on a copper special for publication at some stage. Obviously, Trump's attack on Venezuela has upended previous plans for this podcast. But S&P Global have a huge report out on copper in the age of AI. And they're also forecasting an enormous supply deficit, the equivalent to 25% of demand. And what I think is happening is that copper is being repositioned in the market. So essentially, you've got tech demand, where it's a very small part of the overall cost of, say, a chip, but it's absolutely essential. And you've got basic material demand for like piping, etc. And copper will increasingly be required for the high-tech economy, and it's going to be priced out of the basic material markets.
Yeah, I think that's right. But there are applications. Aluminium can substitute for some transmission cables and
Yeah.
so forth, but there are a lot of applications that it's very difficult to substitute copper, anything for copper. There's iron ore, lithium. I mean, if you look at the longer term chart of lithium, of course, it's come down from a very high, and now it's heading back up.
Yeah, the thing is, Richard, we talked about this later. Well, there's loads of lithium. There's absolutely vast quantities of lithium in the world. It's just we haven't really looked for it. And now, when we
Yeah,
started looking for it, we found loads of it.
I guess the issue is it takes a long time to get it out of to go from finding it to getting it out of the
Yeah,
ground.
absolutely. But this is totally unsustainable. It's going to come down again.
And of course, people are wanting to build more and more large scale batteries, which increases demand. So lithium makes up around 5 to 10% of the cost of a lithium ion battery. But obviously, as the price of lithium goes up, that stat changes a bit.
Yeah, that's true. But I thought this was an absolutely amazing chart about the
Mm,
cost of lithium-ion batteries.
yeah, they have. Yeah, I mean, they're on a steady downward trend. So Moore's
Yeah,
law for lithium batteries,
yeah, brilliant.
except it's not exponential. That's neodymium.
Rising.
Yeah, of course, there's all the Chinese messing around with the rare earth market, which makes it difficult to know where the price changes are caused by that. And the Chinese monopoly on rare earths is a big problem for Western defense companies.
Yeah, lots of obscure rare earth metals used in
Yeah.
yeah.
So what amuses me, actually irritates me, but in the Financial Times, whenever they have an article about rare earths, they always say used in fighter jets. You just think, yeah, but like how much rare earth goes? They're used in everything.
Yes,
And it's
mobile
like, say they're
phones.
used in fighter jets, is like, it demonstrates a complete, to my mind, demonstrates a complete lack of understanding what they're really used for.
Yeah.
That is the trouble with the FT, though. Actually, I read through gritted teeth if you can do that. This is nickel, which has sort of just gone vertical over the last few weeks.
Yeah.
Um,
Now, because previously we've been very bearish about nickel because of this wall of nickel coming out of Indonesia, but they have proposed a potential 34% in 2026 output.
so
Question.
I read I didn't read it, I watched a piece by Rick Rule. He was talking about the Indonesian nickel mines, and he was saying they are causing absolute environmental devastation. He
Yeah,
flew
of
over them and he
course.
said it was appalling. And he said it's going to have to stop. It is not sustainable, and it will stop. And when it stops, mining in this style, when it stops, the price of nickel is going to go up substantially.
Yeah. No, that could well be true, but you know, that presupposes that the Indonesian government cares about the environment, and
I agree.
question
I
mark.
agree, and there's a indeterminate timer on that, isn't there?
Yeah.
That's the price of tin, zinc. And precious metals. And so last year, gold was up 64.6%, silver 147%. I haven't really got these numbers. Platinum up 130%, rhodium up 100%, palladium up 83%. So big jumps.
Yeah, amazing. Well done, mate.
Yeah, so what's happening now? So gold is up 6% since the start of the year, silver 18.
Yeah.
Platinum 16, rhodium 6, and palladium 18.
Amazing numbers. Just when you thought it wasn't possible for them to keep on rising at that pace.
Yeah. So there's gold.
To be fair, gold had a bad couple of weeks at the end of December and has just retraced that to, hit new highs.
Yeah. I mean, the issue really with certainly with the gold and silver market, and I suspect actually with the platinum and palladium markets, is that there has been substantial manipulation of the price. There has been excess stocks, which has enabled multiple year manipulation of prices by futures traders, and they've been able to do it because there has been stock available. Right. And so they've been able to sell futures, mess around with the pricing, and nobody's asked for the physical metal, and therefore it hasn't mattered that they have sold significantly more than the metal that exists to deliver. And that situation has now changed, and people are saying we don't trust the system anymore, we want delivery, thank you very much. And because so many futures have been sold short, uncovered, naked, there isn't the physical to deliver. And so those people who have written these contracts are trying to find silver, physical silver and gold, and can't. And so there's this massive short squeeze going on, and which will ultimately potentially result in the exchanges ceasing to operate in the precious metals market because they cannot obtain the metal that has been promised.
Wow.
So we'll see, really, but it's that's why it's moving parabolically now.
Yeah.
Yeah, I mean, it's gold. Oh, what is this valuation of gold? Yes, the issue with there was a big paper that actually a friend of ours sent, didn't he, which was an analysis of gold against all sorts of metrics over the last 30 years. And you think, well, no, but you should be analysing it over the last 5,000 years. And to my mind, these analyses are based on the wrong premise. They're based on a recent premise that that covers a period, generally speaking, where the price of gold has been manipulated.
Yeah, and it was, yeah.
So the premise is a false premise, and therefore the results of the analysis are wrong. That's been my investment thesis in precious metals.
Well, you've been absolutely right, Richard.
This is true. I mean, in relative terms, these numbers are right, but in terms of how do you view them, I think you have to view them differently to it's overpriced relative to X, and therefore it needs to drop back down. I think there's been a discontinuity in the market, and the repricing will occur, and then we're in the process of that repricing. And once the repricing has occurred, then it'll stabilize. Silver's good, yeah.
Yeah, it's amazing.
There's a lot of people who are hurting very badly in the silver market.
The ETFs that hold a range of commodities will need to rebalance those holdings.
Yeah.
This month, I believe.
Well, I think they're rebalancing over. I think today is the third day into their 9-day rebalancing period.
Okay.
I think.
Right.
But obviously, it's not making any difference at the moment. I mean, these markets are highly volatile, and just because they're up X% this morning doesn't mean they won't be down Y% this afternoon. So it's platinum, rhodium.
Amazing. All done incredibly well.
Yeah. And palladium.
Brilliant. Okay, so quiz of the week, Richard. What was the best performing metal last year?
Best performing metal last year. I take it wasn't silver, Keith. This is a tricky question, isn't it?
It is, yeah. It wasn't silver. There was one that did even better.
It's going to be something obscure.
Not one we cover, obviously.
Yeah, dysprosium.
No, it was tungsten.
Tungsten.
Tungsten was up 243%
Oh, wow.
because, it's used in lots of weapons because it's very hard. You
Yeah.
need it to like put
And
on the tips of shells,
and it's used in fighter jets.
according to the FT. Yes. Yeah. So there you go. 80% of it comes from China, and they've imposed export restrictions.
Oh, wow. Look at that.
Yeah. Silver up a paltry 140%. You must be disappointed, mate.
I just
You could
didn't
have you
realise
could
that.
have done better.
Totally flew past me without my noticing it, Keith. We need to put tungsten into the portfolio matters reporting tables.
Yeah, actually, I tried. I couldn't even find a chart.
I can't find a price
Yeah.
for it.
Yeah. So on to rates. So good news. The UK yield curve has shifted down. Hurrah. So it's a very disappointing December, frankly, because UK inflation came out better than expected. The Bank of England cut rates and the long end didn't move. The long end moved last week after European inflation numbers. So the Eurozone inflation came out at 2%. And then long end fell 10 basis points. So that's all good news. But again, UK yields for a huge part of the range are well above 5%, when UK GDP growth is 1.3% and falling.
It's
Yeah.
the same issue, isn't it, Keith?
Yeah.
The long-term bond buyers are losing faith in the ability of governments to repay effectively with a real return.
Yeah. Well, you've seen the FT reporting that a survey of economists was saying that they thought the government would have to raise taxes again by
I
the
did,
end of the parliament
I
because
did
they,
see that.
yeah,
Yeah. Or God forbid, they could cut costs.
yeah, we know that's not going to happen. So this is the US. Yield curve has come down less actually and is flatter. But this is high rates are not a result of inflation. Inflation expectations are low. 1 year US inflation swaps are now at 2.2%. Inflation is not a big deal. Now, this is a really interesting chart. And we've talked previously about how monetary policy operates with long and variable lags. Well, the yellow line is the proportion of US mortgage holders with mortgages above 6%. It's rising steadily.
Mm.
The number with mortgages below 3%, i.e., which they refinanced during the pandemic, is falling steadily. So monetary policy is still tightening in the US, and no wonder there's an affordability crisis.
Yeah.
The flip side of all that fiscal largesse is actually private sector deleveraging. High corporate profits mean that companies have been repaying debt. You're not going to have a private sector credit crisis. There's the UK 2 year coming down. Hurrah! And actually, that's quite a big move in the last 3 months. There's the UK 10 year also coming down. Hurrah! 30 year still very high, still way too high in my books, but coming down. And what's interesting is that UK yields are coming down. US yields are not. If anything, they're heading in the opposite direction. Is that investors becoming worried about US fiscal situation? They should be. So the more on premium is fading.
Mm.
German 10 year bond yield, 2.8%. Now, this is really interesting. So German 10 year and 30 year yields are rising despite strong deflationary forces. So the 5 year forward for Germany is actually about 0.5%. So markets are not expecting any inflation in Germany. So what that means is you get a higher yield, real yield, for buying German 10-year than you do for buying UK 10-year. So markets expecting 5-year forwards for the UK about 3%. In Germany, they're 0.4%. So, German real yields are higher. But the point of this chart, the black line, is Brent. And the blue line is inflation expectations. In all cases, there seems to be a correlation between oil prices and inflation expectations, something to be aware of if oil prices start to head higher in a couple of years, as we're expecting. So this is France, Italy, Greece, Japan, which has been trending steadily higher. Now, I've been preparing a piece on the Japanese fiscal situation, but obviously we're not going to have time to record it today. We'll do that at some stage. Now, on to current investment themes. And they're same as last time, i.e. AI, monetary debasement, commodity scarcity, energy abundance, peace in Ukraine, question mark. That seems to have gone onto the back foot. Plus, I've added two more: geopolitical uncertainty and the end of Pax Americana, and financial deregulation. So quickly on AI. So obviously it's been a great couple of years, but Mark is also worried about a bubble, and I think AI infrastructure spending must slow because it's reaching the physical limits of component availability, which means AI growth will slow, which means AI infrastructure spending must slow, which means growth in like Nvidia chip purchases must also slow. And so far, Nvidia's growth has been extraordinary. They're expecting 66% year-on-year growth for its final quarter of year-end 2026. Its year-end is last Sunday of January. But, recently, share price has been stalling a bit. Is that a topping formation? Question mark. Now, on to monetary debasement. Well, that trade is going amazingly well. You've seen from the precious metals and industrial metals charts we showed earlier, they're all rising at pace, although Bitcoin's not doing well. Bonds continue to be out of favor. Japanese yen is falling, bond yields rising. We'll talk about that in a future episode. And the danger is that the Supreme Court could well declare that Trump's tariffs are illegal. And that would mean the US deficit increasing. There's no chance that he will increase taxes and reduce the deficit. So markets are placing only about a 27% chance that the Supreme Court rules his tariffs are legal. And they met on Friday and decided to adjourn without passing judgment. Commodity scarcity, well, we're talking about this before, but the main ones where there will be physical scarcity is copper, tin, and uranium. Aluminium or iron, there's loads of it. It's just a question of, the costs of extracting it and opening new mines. That is not the same for copper or tin or uranium. Energy abundance. So the IEA is forecasting there to be a glut of an amazing 3.8 million barrels a day in 2026. Richard disagrees, but the attack on Venezuela will bring more oil onto the market. Peace in Ukraine, well, has Trump forgotten about that? Question mark. The auguries seem to be that the US would force Ukraine into an unfavorable peace, and the costs for both sides keep on rising. I continue to believe at some stage there will be a peace. Now, new geopolitical uncertainty and the end of Pax Americana. So good for defense stocks, basically. Europe is going to have to defend itself. And that's good for defense related commodities. Tungsten, copper a bit.
And rare
Yes.
earths, which are found in fighter jets.
Yes. And here's some ideas for you. These are ETFs listed in London, which look at defense. And actually, I was amazed by the number of them. So this is the Van Eck Defense ETF, doing well, actually doing amazingly well. The Han ETF Future of Defense, doing very well. Global X Defense Tech, all rising relentlessly. And honestly, I can't see these coming down. If Trump decides to seize Greenland, then these go to the moon.
Yeah, and even if he doesn't, they have
No.
many years of profitable business growth.
Yeah. Also added financial deregulation. You know that Trump is lowering the capital requirements for US banks, and Bank of England's talk about doing the same here. Both of that's good for banks and bad for and good for US economic growth and UK economic growth. One a region that's not doing that is the EU, and that's why the EU is stuck in sclerosis. We think that's a good thing, deregulating the banks. Okay, so on to this week's economic data. Unfortunately, there's about a month of it, so there's a lot of it, but we'll try and rush through it. The quick summary. UK stagflation turning to stagnation. Inflation has hit a near-term peak and seems to be systematically coming down. The economy is weak and weakening. EU stagnation with return to the pre-pandemic norms of poor economic growth and low inflation. US actually seems fine, but the labour market is soft. China latest data suggests the economy is up. It's weak, but okay. UK, Richard.
Thanks, Keith. The UK interest rate, as we discussed, was reduced to 3.75%. And UK GDP growth quarter on quarter, 0.1% for quarter three, year on year, 1.3%, both down, both disappointingly low.
Yes, and Q4, is that going to be any better than 0.1%? UK GDP growth, coming right down.
Rachel Reeves' policy, I know we're trying to make this quick, Rachel Reeves' policy is to tax businesses out of existence, therefore raising tax revenues and reducing economic activity. UK CPI month on month in November was 0.2%, minus 0.2%. Year on year was plus 3.2%. So the year on year is still too high. The month on month was better.
Yeah, much better than expected, actually.
Yeah. Core CPI month on month was minus 2.2, year on year was 3.2. So again, better than expected.
Yeah.
And RPI month on month was minus 0.4, and year on year was 3.8. So 3.8 is, although below expectations, is high.
Yeah, agreed.
And service inflation finally coming down, but is still in UK, but still at 4%.
4.4%, and it's coming down it's very, very slowly.
Yeah. And inflation generally broad-based reductions in November.
Yeah, so good news.
And has food inflation peaked? So this is food in the light blue, food, non-alcoholic beverages. In the UK, the proportion of inflation basket rising at an annual rate above 3% has returned to trend. So
yeah,
less broad. Inflation is expected to rise sharply in January because of the dropout of various elements from 12 months ago, and without seasonality, but the projections range from 1% basically over the next 12 months to 10 months to over 4%. Big variety. And the ONS expects UK inflation to stay higher for longer than it did in March 2025, only dropping to 2% by mid-2027. we shall see, shan't we? My sense is that we aren't out of the inflation woods by a long shot yet.
Well, I think we are, Richard. And also, Rachel Reeves has finally decided to help by, cutting energy bills in her attempt to manipulate the inflation numbers down, which we welcome.
UK average weekly earnings grew by 40.7% in October, and excluding bonuses, 4.6%. And public sector pay is significantly outstripping private sector pay under the Labour government. Big
Yeah,
jump there.
I frankly found this shocking. So private sector pay 4%, public sector pay 7.7.
Yeah. Of course, public sector is much larger than it ever was.
Yeah.
And so is rise. Basically, public sector pay growth is rising in contrast to the rest of the economy, which is falling.
Yes. Yes. Labour government.
And UK employment was down 16,000 in October, so not down as much as was expected. So better.
Yeah. Hurrah! We're failing less badly than we thought.
And in the 3 months to November, the public sector, the only one that saw employment growth, which of course is what we need, because
Yeah.
what can you say? I mean, permanent placements and temporary billings indices, I mean, that's jobs market possibly slowly weakening still.
Yeah.
HMRC payrolls counts down 38,000 in November.
Yeah. No, but look at the trend. Forget the numbers. Look at the trend.
Yeah.
That is steadily worsening.
It's not a nice trend, is it? And there's no increase, no correlating increase in self-employment, i.e. people leaving the labour market to be self-employed. That's dropping too. UK claimant count up by 20,000. UK unemployment rate rising sharply, actually, over the last 16 months, from basically 4% to 5.1%.
This is not good.
It's not good.
It really looks like the UK is heading for a recession, actually.
And it's heading up fast.
Yeah.
Retail sales month on month down 0.1 in November and up 0.6 year to date, both below expectations and a bit anemic, really. UK manufacturing PMI was just over 50 in December. And services PMI was 51.4 in December.
Yeah, that's weak by normal standards.
And the composite 51.4. UK construction PMI still on quite a chunky, significant downtrend from a year and a bit ago, a year and a half ago.
Bad.
UK mortgage lending fairly flat over the last 6 or 8 months.
But it's still amazingly strong, actually, given the rise in interest rates and the poor economy.
Consumer credit up at 2.1 billion in November. So basically, that's chugging along at a sort of fairly normal level for the last couple of years.
Yeah.
Net lending to individuals, pretty much doing the same thing, really. UK M4 growth month on month, 0.8% in November. The inexorable rise of monetary aggregates and therefore inflation.
Yeah, they're not printing gold like this.
The UK consumer confidence minus 17. I mean, this is a hard one to interpret, but basically it's been flat for the last 12 months.
Yeah.
Halifax house prices down month on month in December, up 0.6% in the year to date, year on year even.
Yeah. Well, when we talked earlier about difficulty building houses,
Yeah. UK current account is looking refreshingly not so negative as it was last month.
Well, but my point, Richard, is the only time that the current account is better is when the economy is doing badly. And
we don't import so much.
Yeah, exactly. And I suspect the same is true. I think this is probably bad.
Yeah, it's not good anyway. And the UK PSBR at 11.7 billion in November, ahead of or greater than expectations.
Yeah. still not meeting expectations on the PSBR.
No. The surprise index actually looking quite negative at the moment.
Yeah.
The Indeed jobs postings index is actually slightly up.
Yeah,
As a trend.
Yeah, it seems to have, stabilized.
Yeah. UK wage growth is continuing to fall, 5% in November.
But still way too high.
Yeah. And true inflation coming in at 2 and a tiny bit percent.
Yeah. So the good news is much lower than official inflation. The bad news is rising sharply in January.
Yes. UK wage.
Sorry. Yeah.
UK has raised its minimum wage to over 60% of the median wage. The only other country with a similar level is France, and we're converging on France rapidly. Do we want our economy to be like the French economy? No, we don't. Please do something about it. And the UK economy has outperformed the Bank of England's forecast since 2022.
Yeah.
Well, that's a surprise.
It's been more resilient than expected. Of course, in absolute terms, not great, but better than expected.
So growth rates have therefore, which are ghastly low, have been revised higher for the first. And where's our tax money going? Civil service numbers in the UK hit a 2-decade high in September 2025. This is when we're trying to balance our books.
Middle management has increased 132% since 2010. Question, Richard, has public services improved over that period?
No, it's got worse, isn't it? Is there a correlation? Yes, there is. So where are the civil service efficiency gains? Rachel, I mean, the trouble with these politicians, Starmer's just as bad. They think that by saying they're going to address something, the pixies are going to go out and run out and do it. And actually, it's jolly hard work.
Yeah, well, but I love this, Richard. This is such a great chart. It shows basically like the grey lines are like the civil service pay adjusted for inflation. Yeah. The red line is actual pay, median pay. And so what's happened is, although, pay rises for individual grades have been falling relative to inflation, they've just been promoting themselves so they get higher wages. Marvelous. That is the civil service in action.
The cost of renewables. This is one for Ed, isn't it? My mate Ed.
Yeah.
Does he listen to us?
No.
So Ed Miliband, this is not any other Ed. Look how expensive UK energy is, and look what it's doing to our economy and our competition in the manufacturing industries, the chemical industries, and look how disastrous it is for our economy. Ed, do something about it.
Yeah, it's the lying I can't stand. You listen on Radio 4, it's all about how renewables have saved us so much money.
So the summary, read the summary. It is what it is. Stagflation subsiding into stagnation is the prognosis.
And actually, I'm looking through that again. I'm wondering whether we're even going to manage stagnation. I wonder whether we're actually sliding into recession.
Yeah.
Okay, thank you, Richard. On to the EU. So the EU held rates at 2.15% in November, and the market is now expecting that is the bottom of the cycle, and that interest rates in the EU will start to head up from later in 2026. I think that's unlikely, frankly. I don't see the EU economy strengthening, and I don't see how the EU is going to be raising interest rates when the forecasts are for inflation to be below target for most of the next 2 years. So these are the latest GDP forecasts, and essentially, if you exclude Ireland, then EU GDP growth is going to be 1.1%, then 1.3%, anemic. Inflation 2% in December, on target. Core 2.3, subsiding towards target. Producer price inflation, actually month on month, ticked up, but year on year negative, minus 1.7%. so not much inflation. But the EU economy is doing okay underneath. I mean, the unemployment rate fell back to 6.3%. That's a good trend. Wage growth, 3% in Q3. That's compatible with the 2% target if you have productivity growth. However, the ECB's wage tracker shows wages rising again. Retail sales, 2.3%, much better than the UK. Manufacturing PMIs, though, subsiding, not great. Services PMIs subsiding, although that's a fairly decent number. Composite subsiding. So none of that suggests the EU economy is strengthening. Construction PMI, poor. The ZEW Economic Sentiment Index is a survey of economists, and they're actually quite optimistic. Citigroup Surprise Index, positive. In German Indeed job postings, again, like the UK, appear to have bottomed. Wage growth 3.3%. France, however, continuing to decline. French economy weak. And wage growth anemic and well below inflation, actually. No wonder the French are even more revolting than usual. And this is Germany's demographic crisis. That is real. You're having shrinking population. All these countries, UK is an exception to this, but when you've got a shrinking population and growing debt, at some stage, surely that becomes unsustainable. Bottom line is stagnation in the EU. Back to pre-pandemic equilibrium. Low inflation, low growth. On to the US, Richard.
Thanks, Keith. So US interest rates, we discussed, now 3.75%. And likely to fall. GDP growth year on year is 4.3%. Q3, fantastic. If only. Look on in envy.
Yeah, absolutely.
Maybe we should start bombing more countries.
We did back in the day, actually. You should tell Starmer that, back in the day, we had fantastic GDP growth.
Yeah, and we bombed a lot of countries. Yeah. And Greenland's worth having, I reckon. All those mineral resources we can tap into. So tech capex contributes 40 to 45% of US GDP growth over the past 3 quarters. But of course, US tech capex then gets its revenues worldwide.
Yeah, that's true.
So it's a worthwhile investment. US consumption growth remains strong, largest contributor to Q3 GDP growth. And consumer spending on goods and services contribute 2.4% GDP growth. Yeah. So everybody's happy.
Yeah, strong.
And underlying US GDP growth almost certainly weaker than the headline number because government spending recovered to 2.2% after 0.1% decline, so increasing governments. Imports decreased, which effectively increases the GDP calculation.
Yeah.
So basically, a lot of one-off changes that probably goosed GDP.
Yes, in particular, gold and silver imports and exports.
Yeah. So let's wait for the next number to see where it settles down there. US productivity, strong back-to-back gains in the second and third quarters.
Yeah.
It suggests that a lot of the GDP gain was real.
Yeah, well, this is backed out of the GDP numbers, of course, but it's still, anything that we'd kill for this.
Yeah.
Do
you think we really would have to kill for it, Keith? Or?
Well, I would probably like to. Anyway.
Moving swiftly on. US CPI year on year, 2.7%, below expectations. And core 2.6%, again below expectations.
And subsiding nicely.
Yeah.
Actually.
Yeah. Service inflation falling sharply, a little bit offset by goods inflation due to tariffs. And core CPI at 2.6% was a surprise versus consensus expectations of 3%. Probable, possible, but unlikely. And the date is a combination of, because of the shutdown, a combination of changes in October and November.
Yeah, but basically the market didn't really react to this
Mm.
much because they didn't believe it.
Yeah.
Yeah, there's market is skeptical of US statistics at the moment.
34% of the CPI estimates components were estimated.
Yeah.
Market confidence is, as Keith said, declining. But why would they lie? The fall in inflation is coming despite the tariffs raising goods prices. And CPI trending down towards 2%. So US non-farm payrolls, 50,000 in December, a little bit below expectations, declining gently at the moment.
Yeah.
Private sector job creation has slowed. For each of the past 11 months, non-farm payrolls have been revised down for a total of 624,000, which is not surprising that people are a bit wary of the stats, is it?
Yeah. Yeah. Manipulated in one direction. Right.
Yeah. 2025 was the worst year for jobs growth in the US outside of a recession since 2003.
Yeah. When you step back and look at the trend,
Yeah, it's quite
the
marked.
trend is, yeah, quite marked.
Yeah. And the government has succeeded in shedding 277,000 jobs since January. So we need Donald here because he could sort out our civil service for us.
Well, on that front, we do. We just need somebody with some backbone. So all these growth in middle managers, just like chop out a layer. I bet you wouldn't see any difference in that outcome.
Goldman Sachs is forecasting a recovery in US jobs growth this year. No recession, move on. Small business employment is weakening though.
Yeah, look at that. That is a steady trend.
Yeah. 9.5 million Americans doing more than one job to make ends meet.
Yeah. It's a K-shaped recovery. The poor are not
Yeah.
doing well.
Yeah. So US average weekly earnings month on month, 0.3% up in December, 3.8% for the year.
Good.
Inequality continuing to rise.
Yeah. So the top quartile are getting much better pay rise than the bottom quartile.
Yeah. And consumer sentiment is terrible.
Yeah. Not surprisingly, when you know,
Yeah.
rich are getting richer, poor are getting poorer.
Yeah. US participation rate, 62 and a bit. So it's a very slow downtrend, really, really almost not a trend. US unemployment rate fell 4.4%.
Well, that's great news actually, because previously it had been rising. Ticked down again. Good
Yeah.
news.
And the US U6 unemployment rate was 8.4%, less than expectations. And rising spread between U6 and U3 unemployment rates suggests rising underemployment.
Yeah. And that itself is a sort of a bad indicator for the
Yeah.
economy.
Yeah. JOLTS openings dropping, still on a downtrend, 7.15 million in November. And the JOLTS quits also dropping. Well, actually rising, but in fact, still on the downtrend. Layoff rate is subdued and no sign of a rise presaging recession.
Exactly. So in order to get a recession, you need a negative feedback loop to start kicking in, i.e., people lose their jobs, they cut their spending, which means that there's less money going through the economy, so other companies start laying people off. That's just not happening.
So the hiring rate is falling back towards its lows, however. So the jobs market is slowing down, I think.
Mm.
If job openings continue to fall, then you would expect unemployment to continue to rise.
Now, what's happened this month is we saw job openings fall, but the unemployment rate also fall. That shouldn't happen. If job openings are falling, then unemployment should be rising. So expect the unemployment rate to revert higher next month if job openings continue to fall.
ADP employment change up 41,000 in December, and challenger job cuts has really pretty much dropped back down almost to the low point of this recent range.
We're not seeing a rise in layoffs.
US industrial production year on year up 2.5% in November. Good, strong numbers.
Yeah, actually rising.
And US manufacturing production year on year 1.9% in November. So again, looking quite healthy.
Yeah, in big contrast to Europe and the UK, where industrial production terrible.
Manufacturing PMI is 51.8. Services PMI 52.5. Nothing remarkable about those. Composite 52.7. Manufacturing PMI 47.9.
So this is ISM.
Yeah. And ISM services PMI 54.4.
Which once again is heading in precisely the opposite direction of the S&P Global non-manufacturing PMI. This has happened before.
Yeah.
But it's quite striking the amount of difference between the two at the moment.
The CB consumer confidence 89.1. It's on a downtrend, but it's not a steep downtrend. Slow. It's not looking great. Case Shiller month on month down 0.3 and year on year up 1.3.
Yeah, so US house prices weakening, house price inflation weakening.
And initial jobless claims 208,000. Nothing remarkable there. Continuing jobless claims 1.9 million. Bit on the high side, but
not increasing.
No. Warn notices rising, which suggests there are more layoffs in the pipeline. Haven't come through yet.
Yeah,
there's about a 2-month lead between the warn notice and the actual layoff. The jobs posting index 104.7, so possibly settling down to a standard, to a more level. And wage growth 2.3% in November, so very sustainable regarding the inflation.
Yeah.
Link up jobs postings are falling.
Yeah, this was direct contradiction to the Indeed one. Anyway.
Yeah. So the Dallas Fed weekly GDP to estimate 2.1. The Atlanta Fed for quarter 4, 5.1.
Wow.
It's big, isn't it? The New York Fed this week, 2.6.
Yeah, now this is the one we like best, and it's showing a strengthening US economy.
Yeah. And the St. Louis minus 0.34.
Yeah, okay.
Yes, the City Group Economic Surprise Index 7.8. I mean, it's like not far off the zero axis, really, is it?
Yeah.
And Trueflation 1.88, 1.9%.
Yeah, fading inflation pressures in the US. That's great news.
Yeah, manufacturing investment is falling. Mind you, it has risen massively in 2023, 24. So it's not surprising it's going to fall off at some point.
But that's bad for the economy.
Yeah, and domestic investment is also falling. But AI investment continues to grow, but the rate of growth has fallen back to 5%.
Yeah.
And the truck sales in November were revised lower. So truck sales is very noisy over that sort of time frame of a few years.
Yeah, but it's said historically big falls in truck sales, because that's mainly construction. So you talk about diggers and stuff. It's been a big leading indicator of recession, and it's just not working.
No. Not yet. Anyway, so tariffs have succeeded reducing the US deficit, which was down 17.4% in December.
Yeah, compared to the previous December. So, yeah.
And also reducing the trade deficit. But numbers also distorted by gold and silver. So I think we need to let that run out of the system, don't we? And a few people are forecasting a US recession in 2026.
Yeah, based on rising unemployment. But, it's not clear that will continue.
Yeah. So there's a summary, and the bottom line is US economy is doing just fine, though the jobs market looks like it is weakening a bit.
Okay, quickly on to China. Inflation ticked up as essentially going nowhere. PMIs, manufacturing up a bit, general up a bit, rain dog, which is the private sector, up a bit, um, services down, but 52 is all right, and general up a bit. So China's economy appears to be stable, but fiscal, actually we covered that last time. No sign of recession, essentially, China. And onto one chart. So this is copper foil. And copper foil, there's only a couple of companies in the world make it. And this is super thin foil used in the manufacturing of semiconductors. And it can't keep up with AI demand, essentially. So battery foil, which is slightly thicker foil, less high quality. There's lots of it. But circuit foil for AI accelerators and chips is cost 10 times more than general purpose foil, and there ain't enough of it. So printed circuit boards are made by stacking multiple sheets of copper laminate with fiberglass and resin, etc. And it is ultra thin. It's 2 to 5 micrometers, about 1/30th the thickness of a human hair. And it has to be perfectly smooth for optimal adhesion. So there is a severe shortage of very low profile grade 4 circuit foil expected over the next couple of years. So circuit foil manufacturers are retooling to increase supply, but the question is whether they can expand capacity sufficiently to meet booming demand. So everywhere you're seeing the AI infrastructure boom just hitting the limits of components availability. And I think it just has to slow. And while we talk about this, so thank you to Magnets and Cubes from the Discord channel who put me onto this. But um, essentially, OpenAI did this deal in October where they bought up around 40% of world DRAM supply. So when I was down seeing my nephews over Christmas, they built themselves a new gaming PC, and they were complaining about the price of RAM and how it had gone up 150%. And this is all related to OpenAI basically cornering the market. So DRAM supplies have gone through the roof, up 250% since October. So this is one DDR5 card, and this is I've chosen this at random. Basically, this is its price according to Amazon. So I took this chart directly off Amazon. Previously hit a low of $85, now 330.
Done better than tungsten, Keith.
Yeah, absolutely. So the bottom line is, I think, the current pace of AI infrastructure boom is unsustainable because you just can't get the components. So I think that means the revenue growth of Nvidia, etc., has to slow in my books. And actually, we're doing two one charts this week, and the second one is this, which I thought was astonishing. This is the percentage share of wages in the US economy, and it's the labor share of the economy, and it just keeps on falling. And so no wonder US workers are unhappy. Corporate profits, etc., are rising, but workers aren't benefiting. It's the lowest it's been since the 1940s. And frankly, it's the lowest it's probably been for much longer than that. That's when the chart starts. So this is all recipe for a voter rebellion. Yeah. Workers aren't doing as well as the economy. So Simon W from our Discord channel, who has played markets incredibly well over the last couple of years. I asked him to do some technical charts looking at all the markets that interested him actually to see whether the strong rises we've seen recently are sustainable and what he thinks his views of the markets are. So we're quickly going to go through these. Richard.
Thanks, Keith. So it's copper. You can see it's a series of upward runs with consolidations, and there's no sign that the bull trend has broken down. And copper mining shares basically showing a similar sort of, this is over the last 6 months or so, just looking at the right hand end of the chart, showing a similar sort of pattern, but with a breakout and a gap actually at the top for the last week. So strong breakout to the upside. That was Southern Copper, wasn't it? So tin is breaking out above previous high. It's broken out of its channel. Gold rising steeply in a narrow channel. And he comments that looks like it's being managed and rising in a controlled manner, possibly so. And this is suggesting you should watch a breakout above 4,600, which might signal a pullback, might do. I think the problem with all the technical analysis that I've seen on the gold market is that it's all been wrong because all the technical analysts have been using the wrong framework. So I think you have to be really careful. I mean, you have to be very careful with this anyway, but Simon W thinks that he's not rising too far too fast. And it's gold equity, London mining, rising steadily. No sign of topping. Has risen substantially, though, up fourfold in the last 6 months. Silver, yeah, so I would disagree with him there. He says high downside risk. I'd say that would be the case if this chart were based on an unchanged environment, but my view is the environment has completely changed and therefore the basis of the chart analysis is wrong. That's my view.
Yeah, and I'd also say that the price is now 84, so it's just kept on rising.
Yeah. But obviously you don't, it's difficult to get in at this point and you don't want to, you've got to be really careful you don't get caught out. Uranium, no strong trend in a consolidation pattern. Well, maybe, but it's still it's been in an upward trend since early 2025 and it hasn't broken that upward trend. And uranium miners, so they've had a bull flag and they've broken out of that bull flag recently, which is bullish. There's oil, which is in this downtrend and no sign of a bottom yet. NASDAQ, I have no idea really. Above the top of its trading channel and therefore overbought short term, but rising trend firmly intact. I don't really, yeah.
Yeah, I think I'd agree with that actually.
Yeah.
So January, you'd tend to have this surge in the first couple of weeks and then a consolidation, and you have this seasonal volatility really picks up.
Yes.
Now. So I think that's kind of all. Yeah.
So this is the S&P 500, and the commentary is well above the top of its channel, due a correction, but uptrend remains intact. And the FTSE rising strongly, bullish. Yeah. And the Nikkei broken out of its previous trading range, bull market firmly intact. And these steep rises. So there's a summary of his views on the various sectors, basically bullish on pretty much everything except silver.
Yeah. So basically, he's saying, obviously, reminder, this is not investment advice. Do your own research. But Simon W's view is that, stay long.
Yeah.
And I say your view as well is stay long.
I think generally speaking, I don't think there's going to be some gigantic crash.
Yeah.
But I'm in very specific sectors. I'm not in tech, so
Yeah, I'm not in tech either. And my concern over the course of the year is that I think the tech bubble will not necessarily crash, but it will deflate. And when the tech sector goes down because it's such a huge part of the
Yeah,
S&P 500 and the Nasdaq, that will bring equities down.
yeah,
Now, I'm looking to time my move into oil. So,
yeah,
how much that matters to me, it really doesn't matter. But I am long copper.
yeah.
And one of the things I've done last week, is that I sold all my names, apart from a few specky ones, and I bought instead the ETF. So I'm highly liquid. I
Is
can
that
do,
the global copper miners ETF?
yeah.
Yeah.
So I've done there are three copper miners ETF. There's the iShares, the
Hmm.
Sprott, which is pure play copper, it's kind of more speculative, and the Global X miners.
Yeah.
And because of the bed and breakfasting rules,
Mm.
I will be aiming to take some profits by the April to realize some gain. And you can't, obviously, if you buy within the same month, it's not allowed, yeah,
Yeah.
it's not treated as a gain. But if you buy,
Yeah.
let's say you sell the iShares and you buy the
Yeah. Buy
Global
the other
X,
one. Yeah.
that is allowed. So
Yeah.
that's kind of why you might want to spread them out a bit.
Yeah.
Okay, we're going to cut it short there because it's already been an extraordinarily long episode. Thank you all for watching. Concluding comments. Well, Happy New Year. But it's been an extraordinary start to the year. Donald Trump is feeling disinhibited and is trying to accelerate his agenda before the midterms in November, in my opinion. Expect more geopolitical interventions and in the form of raids and bombings, but not troops on the ground. So we'll just have to react to
Yeah.
that as it occurs. Meanwhile, the market melt up continues. At some stage, there has to be a top. But so far, every attempt to call one has been wrong. Richard, what are your thoughts?
I agree, Keith. I think, yeah, I agree with what you've just said.
Um, So I've done a couple of things actually. I've been buying small spivvy stocks. So this is East Star Resources. It's gold and copper explorer with assets in Kazakhstan. And as the price of these things rise, so the price of exploration assets, anything they find, will obviously have risen a lot, and that's worth a punt. Gunnison Copper, which I've long-term viewers will remember had this in situ acid extraction resource in Arizona. That they've turned it into an open pit mine, and they're looking to sell that to a bigger miner. So near-term upside possibility there. And this is super spivvy. Fitzroy Minerals. They are exploring for copper all around the world and have assets in the Andes and stuff. Anyway, um, and lastly, tin. There is a tin ETF which I was unaware of and has been doing very well, but it's the physical tin. So if you want, tin is one of the elements we think is rare in the Earth's crust and where there is a physical shortage of. It's essential to electronics. Demand is growing. So if you want exposure to tin, there is listed on the London Stock Exchange Wisdom Tree tin. So that's it. Very long episode. Hope you're all doing well in these uh, bullish markets. I have prepared, or I'm in the process of preparing, lots of big sections. One on investing when you have to pay 24% CGT. Thank you to Mr. C. Peckham for his forbearance as I produced that. One on copper, on Japan and the possibility of fiscal crisis, and also I want to revisit the toboggan trade, etc. But we didn't have any time for that this week. We'll be back in 2 weeks' time. In the meantime, thank you very much for watching, and it's goodbye from Richard Wheater.
It's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.